All right, everybody. We want to thank you for coming to this week's weekly multifamily roundtable. This week's guest is let me pardon. Hang on just a second. I got to mute this. There we go.
Getting some feedback there.
Yeah, the sound off of the live feed. This week's guest is Scott Maurer. Has worked with Advanta IRA since February 2006, and he serves as Director of Business Development, presenting various seminars, webinars, and educating the public on the intricacies of self-directed IRA investing. And additionally, Scott has assisted numerous clients with investing using their self-directed IRA accounts and is very familiar with the process involved with all types of investments. Scott's also a licensed attorney, having graduated from the University of Florida Law School in 2005. So welcome to the show, Scott.
Hey, Rodney, thanks for having me. I appreciate being on with you guys, you and Dan and Anthony as well.
Yeah, we're psyched to have you.
So I'm happy to come on, Dan, and anyone who's listening, live as we go through. I think we'll be happy to take questions as we go. I really wanted to just discuss tonight really the basics of some self-directed IRAs, and certainly can touch on the very entry level terminology, processes, et cetera. But then really happy to dive into deeper topics as you have the questions. But I think to kind of start out for the uninitiated, what a self-directed IRA is really it's a retirement account that allows you to take your IRAs, your old 401k accounts, and rather than invest those in stocks and bonds and other publicly traded assets, the self-directed IRA gives you the flexibility to use that money into various alternative assets. And certainly as the podcast we're talking about tonight, we're talking about multifamily, a form of real estate investing. That's what we see a lot of clients invest in. People who have that IRA, have an old 401k, want to buy a rental property. They want to buy a rehab. They want to buy into a multifamily syndication. You can use your IRA. You can keep it tax protected with a self-directed IRA. If you were to go to your brokerage firm, or your bank where your current account is, they're not going to allow you to make that type of an investment simply because it doesn't fit their business model. But companies like Advanta IRA exist to hold these alternative assets within a retirement account, and the gains that you generate then from those investments are what's helping to grow your retirement account on a tax-deferred, potentially tax-free basis, depending on the type of IRA you have. So it's a very little-known tool. There are not a lot of people that know you can self-direct. There's probably less than 5% of retirement accounts that are out there are in self-directed assets, something alternative. But certainly they're becoming more prevalent, I think, as people get tired of what happens on Wall Street, the ups and downs of the stock market, looking for something more secure, or, obviously they're, even so much as, hey, I met a guy, or it's a friend of mine who's raising capital for their next real estate deal. I know that they do very well in the deals that they have. He's very successful. His investors are successful. It's a way to get in. It's another way to invest using your IRA. And again, most people, have no idea that this is possible, to use retirement accounts to invest in something other than stocks, bonds, and mutual funds. But hopefully tonight, that's the kind of information I can share with everybody on how to do it, what's involved, and really how easy that process is.
Yeah, we're really excited to have Scott in particular. Dan and I have worked with Advanta IRA. Dan has, on our last deal, a couple passive investors working through your guys' institution in particular, and it was really educational, and really like the process of working with you guys has been really easy, and the communication has been great. So that's like the reason that we in particular reached out to you and are like, let's talk to Scott. So let's break this down and talk through what type of retirement accounts that we can actually use.
Sure. So the self-directed IRA, again, the important thing to note is the self-directed term refers to your ability to invest in alternative assets. So the self-directed is not a per se type of IRA that the IRS recognizes. So the IRS recognizes a traditional, tax-deferred IRA. There's the Roth IRA, which is a tax-free account. There's SEP IRAs and simple IRAs for self-employed individuals. So all of those accounts, any type of IRA, traditional, a Roth, a rollover IRA, a SEP or a simple, those accounts can be self-directed. So again, self-directed simply means you're using one of those vehicles to invest in an alternative asset. Again, mainly real estate is what we see. So any type of IRA can be self-directed. People who are self-employed can do solo 401k plans. So if you own your own business and you don't have any employees, a solo K is a great avenue to save and to also make investments through. And certainly any old 401k. And I say old 401k, that also includes 403b plans, TSP plans, basically the employer plans. So if you work for a private company or you work for the school board or the local government or even the national and the federal government, they all offer employer-based plans. And that's where a lot of IRAs actually get started. People working for an employer who is, they're contributing part of their salary into the plan and the employer is doing a match on top of that. So those 401ks, those 403b plans, when you leave your employer, you have the ability to take that money and roll it into an IRA. And of course, if you have that money and you want to use it for real estate, you roll it into a self-directed IRA. So really the accounts that can be self-directed, any type of IRA account, any old employer plans, and certainly the solo plans for self-employed individuals. The only accounts that are somewhat off limits, I should say, and I don't want to say off limits because it's certainly possible to use them in certain circumstances, is a current employer's plan. So if you're working for a business now that is offering you a 401k or 403b, they may restrict your ability to move that money while you're still employed there. So that is the one restriction that is in place sometimes on being able to self-direct the funds. So if you're currently employed, you need to check with your administrator to see what's available. But any former employer's plans, without a doubt, can be moved. And certainly any IRA accounts that you have can be self-directed. It's a matter of just filling out the right paperwork to get the money moved over and get it in place ready for your investment.
Yeah, that's something that I've noticed confuses quite a few people. Because when I'm talking to investors about, where to find the funds to invest, I bring up self-directed IRAs all the time. And like you mentioned, most people don't even know they exist. And usually early on in the conversation, I think people think that a self-directed IRA is like another version of a Roth or a traditional, like it's another type of IRA. But really the most important thing to understand is that the self-directed portion there really just refers to the institution that's holding those accounts, as opposed to the actual type of account they are, right?
Yeah, exactly correct. And sometimes you have to be careful. There are brokerage firms out there that say, hey, we have a self-directed IRA. And what they're referring to is that when you have an account through them, you go on their platform, you choose your stocks, you choose your mutual funds. They don't have an advisor, do a risk profile or something like that and suggest different investments to you. So you're choosing your investments, but you're still selecting from that limited pool that they have. Truly self-directed IRA, you can take that money, use it to invest in, different real estate projects, do private lending, buy silver and gold. There's so many different things you can do, but you have to make sure you have the right kind of self-directed account.
So does the brokerage itself need to have a certain certification to carry the self-directed aspect, or is that just part of the product portfolio they choose to offer or don't choose to offer?
I think for the brokerage self-directed IRAs, that's just a more of a hands-off approach that they have. I don't think they have to have anything special for that. There are some brokerage firms that will hold certain, kind of those truly self-directed assets that we specialize in. Every now and then you'll find a brokerage firm that will hold a private placement, maybe a hedge fund offering or something similar to that. But in order to hold that, a lot of times you have to go through a lot of legalese because, again, it's not something that they make available on their platform. They're usually not going to make it available to the general public by any stretch. It's usually kind of one-off situations for certain clients, maybe preferred clients, and then they go through a lengthy legal process to even hold that asset. That's not something that we have at Advanta. We are not an investment advisory firm. We're not a brokerage firm. We're an administrator that when you have an alternative asset that you want to make and make that investment inside of your IRA account, we can help facilitate that. Keep the investment tax protected, but we're not going to have a lengthy, legal review process over your paperwork. Our role is to make sure that it gets properly, the asset and investment gets titled properly in the name of the IRA. Make sure you approve of it. We leave the due diligence and the legalese check. That is to the individual client. That is why it's called a self-directed IRA. Is the individual account owner is the one really in charge of doing their due diligence, making sure the investment is right for them, and our role is to simply facilitate it.
So then, based off of that, I'm sorry.
Oh, go ahead.
Now we can fight over this. I was going to say, so based on that, and how does the fee structure for you guys differ than like a typical brokerage?
Yeah, so I mean, a typical brokerage firm is going to probably charge either fees for the different trades they do, or they're charging a 1% fee to manage the account, on your portfolio. Our fees are just flat record keeping fees. So, for instance, if you were to invest say $100,000 into a real estate syndication, you're looking at about $150 to get the account opened and funded, and then get the investment made. And then on an annual basis, we charge a flat $295 a year to hold that asset. So it's not a percentage-based fee that we charge. It's a flat fee just based on our services to do the record keeping for the account, receive income back into the account, pay any expenses out, and do the IRS reporting. So a lot of times the brokerage firms have a percentage management fee that they're charging, usually probably right around that 1%. Again, you might find some others that don't have the fee, but then they're probably hitting you with different trades every time you buy and sell stock. So just again, so make sure you're comparing. I tell the story a lot. I had a guy once sit down and at a seminar we did, and I went over the fees and said, hey, we charge $300 a year to hold a piece of real estate or an asset like that. And he thought it was ridiculous because his account statement from Ameritrade or Ameriprise or Fidelity, whoever it was, showed annual account fee $25. It was that was the stated fee on his form. And there happened to be an advisor sitting in the room who actually looked at his statement. So let me look at this statement here, and started showing him all the other fees on the statement that don't show up at the word fee. It's not labeled as such. And he was able to indicate he was probably paying about 1% total on a $100,000 plus account when he thought he was only paying $25-50.
Yeah. Yeah. What I was going to mention there before, which is pretty much what you just kind of confirmed there, was my assumption that the reason why you don't see Schwab and Vanguard and Ameriprise and those other institutions offering a self-directed option is because it's just not in their business model. They're selling products basically. Whereas you guys are just there to facilitate a transaction. You're not making commissions. You're not selling things basically, right? So there's no real incentive for them to offer something that they can't really sell, right? Am I interpreting, or is that accurate?
You're right on, Dan. I mean, that's the bottom line. I mean, they make money off either holding mutual funds or selling mutual funds or stocks within their accounts. Mm-hmm. So again, when you do see the rare situation that they will hold an alternative assets because they're maybe doing a client a favor or something similar to that. But yeah, their business model, they could certainly do what we do as a company. They're within their rights and their legal ability to hold alternative assets. But what we do, I mean, anyone who's ever bought a piece of real estate, whether it's your own personal residence or a vacation or a rental property, there's a lot of paperwork involved to buy a piece of real estate. Even for short cash closings, there's still some paperwork involved that has to be done. And that's something that I think that's the other reason they choose not to do and make these investments is there are subscription documents, there are contracts, et cetera, that have to be completed. And they're just not set up as a company to handle that. It's not what they were started as. It's not how they exist now. So I think that what you said, Dan, is right on why they don't handle it. It's just not their business model. It's not that it's against the IRS rules, which some people then conflate. Well, if I can't do this in a brokerage account, then that must mean it's not possible. And that's simply not the case.
Yeah, something I said the other day when we were chatting was that it's always important to follow the money, right? Whenever you're looking at something, potential deal, find out how the other parties in the deal are incentivized, and you'll probably it's a good practice.
Mm-hmm. Yeah, absolutely.
Probably in lots of walks of life. That's true.
Yes.
Yeah. In this business, always, and in life in general, just follow that money. Understand exactly how the other person's getting compensated, because that's going to tell you a lot about their motivation and why they're pushing the products that they're pushing. And so I find that really interesting that you guys do a flat fee as opposed to a percentage, because it just shows where the alignment of interest is inherently. So we got a couple of people in the chat. Just wanted to say, hey, welcome. Actually, we have Michael Scott. Dan, I don't know if you know that person, but I'm sure that's from the office. I don't know.
I hope that's the.
I hope that's the Michael Scott. Yeah. But if you guys have questions as we go, shoot them down in the chat, and we'll get to them as they come up. So, Scott, next, I'm curious, because you mentioned all the paperwork that you have to do. one of the questions then that investors are likely to have is, how difficult is this? How much work is it for me to transition my current retirement plans into a self-directed plan?
Well, I mean, I've been doing it in the industry now for almost 15 years, so I think it's easy because I've done it repetitive. But yeah, that being said, the first-time investor, it's going to be maybe a little daunting, only because it's something different that they haven't done before. But it is, if you have an account at a brokerage firm and you want to make an investment into a syndication, it's a matter of just doing the right paperwork, and that's what we do. Initially, helping someone come over, we're going to help you fill out the paperwork to open up a bank account. You're giving us your name, information, your beneficiaries, and then you're filling out a form telling your other custodian to send money from your IRA there to the IRA account that you open with us. And we're helping people every step of the way. So getting started is just doing that paperwork and getting it completed and getting it sent back to us. And then when you actually go to make the investment, I would say the more daunting part, if anything, to be honest, is not the paperwork that we help people with. I mean, we certainly will go through the subscription agreement of a syndication deal, make sure the IRA is properly titled, make sure the client has reviewed and approved it. But really the more daunting thing to me would be the client actually deciding that the investment is right for them and going through their due diligence and looking through the prospectus and the PPM and talking with the sponsors and becoming comfortable with the investment. Once they decide to do it with their IRA, it's just a little bit different titling that's involved. And again, we're going to be there with our account managers helping you every step of the way to get that paperwork completed correctly, to keep, minimize and eliminate any tax consequences for doing so. So it's just a matter of paperwork. And some people hate paperwork, but we try to make it as easy as possible. And that's just, and frankly, that's just how it is. I mean, if you guys know, you take syndicators or you take investors into your syndications, they have to complete a subscription agreement. That's just how it works. Mm-hmm. It's no different with the IRA account. It's just different wording that's used on that document.
Now, you guys don't advise individuals on whether or not a particular investment is good or bad, right? You just make sure the paperwork's done properly, but you're not going to be taking like an advisory type of role. Is that correct?
Correct. So it's completely up to the client to be comfortable with the investment itself. Again, looking at the underlying metrics and data and deciding that's for them. We're, the good thing in one sense is we don't put up any roadblocks. We're not going to, like I said, review the syndication PPMs and the other documents and raise flags for the client. We're simply going to say, hey, this is how the IRA, if you're going to make this investment, this is how it needs to read. So it's very easy for someone who's decided they want to make this investment to do it. The hardest thing that client's going to have is if they do have money at a brokerage firm and they're wanting to move it over. Sometimes it's calling your brokerage firm and saying, hey, I need to move $100,000 from my account with you to my account with Advanta. No, they don't like it. And then you get the advisor trying to scare them. And that's something, obviously, I don't know how often you all have run into that as syndicators where, someone wants to invest, but I just talked to my advisor and he said this is risky because they don't understand it.
Breaking up with someone, I feel like, with some people, because they've been with someone for so long and they've got to call this guy who they're kind of friends with and essentially break up with them. And so it's kind of a crummy call to make. But I mean, if you do the math, you got to do it.
Their investment isn't risky at the same time.
Yeah, this was actually a topic that came up on Bigger Pockets the other day, that in the forum they're talking about wanting to transition into real estate, but their brokerage manager was like, this is a really bad idea. It's really risky. Everybody loses money in real estate. And so there's this underlying theme of, well, if you take your money out, they're losing their compensation. One, so that's bad. But two, that's the world that they operate within, and so that's what they understand and what they're incentivized to push.
Mm-hmm.
Hey, Scott, is there something that I can't invest in with my self-directed IRA?
Yeah, there's when the IRS created the accounts, when they created the IRA itself back in the 1970s, they only said there's a few things that you cannot invest in with the IRA account. They put restrictions on investments. They didn't make a bunch of, a big list of all the things you could do. They said you can't buy life insurance and you cannot buy collectibles inside the IRA. So when you talk about collectibles, you're talking about artwork, antiques, collectible coins, things of that nature. So those are the two prohibited investments you cannot make in the IRA. And they also, in addition to that, added one other rule that your IRA cannot transact with or benefit. So IRA makes an investment, they cannot be transacting with or benefiting certain disqualified persons from the IRA. And for an IRA, which is its own legal entity, the disqualified persons include the IRA owner, their spouse, the IRA owner's parents and grandparents, and the IRA owner's kids and grandkids. So those are the disqualified persons, again, that cannot transact with the IRA and cannot receive any benefit from the investment held in the IRA. So a couple quick examples of what that would mean. If I owned a piece of real estate personally, I cannot sell it to my IRA. That would be a prohibited transaction for my IRA to buy it from myself. If my IRA bought a property, a piece of real estate down on the beach, it's got to be strictly for investment. It can't be something I want to use on the weekends or when it's not rented. It's got to be strictly hands-off. So those are the kind of the prohibitions that are out there. For people who are looking to invest passively in other individual syndications or in lending money to somebody, as long as you're not doing that, as long as the person, the sponsor of the syndication or the person who's borrowing the money from you, as long as they're not disqualified from your IRA, you're not going to have any restrictions. Those rules aren't going to show up. And I see, unfortunately, some people get hung up on that rule a lot because their initial investment is, hey, I want to buy, I'm going to use my IRA. I'm going to buy this condo at the university, and my son's going to rent it while he goes to school there. You can't do that, unfortunately. And then that blows up their idea, and they miss the bigger picture that there's still other things you could do. You just can't benefit those certain disqualified persons. But again, outside of that, those prohibitions, it's really wide open what you can invest in. We've seen some really odd investments. Most of what we see is just real estate related, rentals, rehabs, tax liens, syndications, notes and mortgages. And then really a lot of hedge funds and other types of private placements are really the bread and butter of what our clients invest in. But there's definitely some unique things here and there.
We have a question here from Mike asking, what does the process look like if you currently have a solo 401k with another company and you want to move it over to Advanta?
That's a great question. That's a little bit more involved than just a regular IRA to IRA, which is fine. So the question for Mike would be, and this might be something either he can answer back with questions we have, or we can take it offline at some point. But if you have a solo K with a brokerage firm, what you can do is you can open up a solo K with us, basically just open up the account in the same name, the same plan that you have with the brokerage firm, and basically adopt our 401k plan document. So the plan stays the same, the plan name, the plan tax ID, all that information stays the same. You just choose to stop that relationship with the brokerage firm and adopt our 401k plan document and then transfer the money over. So it's a matter of, again, of just doing the right paperwork to have that happen. If you're looking to diversify, both having money at the brokerage firm and with us, it gets a little trickier on whose plan documents you're going to adopt. But again, it's a matter of just getting those ducks in a row and getting it done right. But moving money from an IRA to an IRA or from a solo K to a solo K is done with a transfer form. It's a one sheet of paper you fill out, giving us the information on your other account, the firm, your account number there. We submit that paperwork to that other firm and request a direct transfer. When the money goes directly from one custodian to the other, it's a non-taxable movement of money. So that's an important thing to note. No tax consequence to move money from your brokerage account to a self-directed account.
Now, what's the timeline usually look like for this? Because I think the most common type of person I've spoken with, as far as an investor goes, is someone who has at least 2 or maybe 3 or even 5 different IRAs, usually scattered between at least 2 different institutions. Mm-hmm. Let's say that me and this person, we're starting at ground zero. They just decide, okay, I want to invest in real estate. I've known this for a while. I've been doing my research. And now I just found out about self-directed IRAs. And I'm super excited. From time 0 there until funds are transferred and they're ready to actually close on a deal, how long does that usually take for the average person?
The average person, from the time we get the paperwork and actually get the account opened, it's the time they get the money in-house and ready to go, probably anywhere between a week to 2. Okay. And it depends. The biggest factor is where they're moving the money from. If you're moving money from an old 401k account, unfortunately, those companies, for whatever reason, usually will only send a check. So if you request that rollover, they only send a check, and that's just going to take longer in the mail to get that money. But when it comes to like IRA to IRA transfers, I've seen, we had a client move $1 million from another brokerage account, and it took a day via wire, just that quick. Other custodians, though, have different requirements. Some of them will take faxes, some of them will wire money, and it happens in a few days. And there's other custodians that are, require wet ink original signatures mailed to their office. And in those situations, it's going to take more like a couple weeks just because of the time lag in getting them the paperwork and getting it processed. And again, as we talked about already, they have no interest in speeding up that process to liquidate the accounts and send that money out. Again, it's something that will definitely happen when you do the right paperwork. But so the ballpark, generally speaking, between a week and 2 weeks to get the account open and funded.
Yeah, no, I can confirm that on the 401k custodians, because I helped my sister a couple of years back when she was my first person I worked with on getting into a self-directed IRA. And it was always those other like old institutions where those like random old employer 401ks were scattered around. Like there was a couple of them where they made us send in faxes to request the transfer, and we're like, okay, well, where do we even find a fax machine these days? And then they would cut the check, like you said, and it would take forever. So I would say that people should probably err on the side of allowing a little bit of extra time for those types of institutions, because to your point, they have no incentive to hustle with that kind of stuff. They like to take their sweet time and they like to make it difficult. So
yeah, most of them aren't too bad, to be honest. I mean, I'm not going to paint with a broad brush on that. I mean, most of them are pretty good. Especially the 401k companies, they'll generally, issue a check within, a few days of your request. It's still a check. It's still got to get mailed to us. But every now and then I had a lady opening an account with us in last December to request a rollover by the end of the year last year. That check didn't get to us until the second week of April, because you have to have your request in by the end of one quarter. Then you wait basically a whole quarter for them to actually cut the check and issue it. That was with a state retirement system. She was a state government employee, and that happens every now and then. That's just that's the oddball, but that's where if you're considering doing this, that's where you want to look into. Hey, I have these monies in these accounts. Give them a quick call and say, hey, if I wanted to move this money to an IRA account, what's your process? What's the time frame, et cetera? And again, most of them will work pretty quick once you get them the paperwork.
Yeah. So I guess it makes sense to, get all this administrative stuff done prior to you identifying a deal, so that when something pops up, you can pounce on it.
Yeah. And unless you're going to have a lot of lead time where you sign up for an investment, you have a month to fund it, then you'll probably be okay. But if that's not the scenario, get the money moved, get it ready to go. If you have money in another IRA account, you can always do partial transfers of IRAs to have your account up. And I've had some people do that. They wanted to test the process. I want to be able to make an investment. Let's go ahead and move $1,000 over just to see how long that takes, so that when they do find an investment, they know then what kind of lead time they have to get those additional funds transferred.
So that kind of leads to, if you do transfer funds because you're going to invest in real estate and you haven't identified the asset yet that you want to invest in, does the money draw interest while it's sitting there, or does it not do anything until it's actually invested?
Yeah, that's the unfortunate part. It's not going to do anything until it's invested. It's going to sit in cash. It's going to be FDIC protected, but it's not going to earn any interest. So it's not going to go up. It's not going to go down. It's just going to be kind of sitting there flat, which is probably the reason I think a lot of people don't generally move money to us, or at least move the bulk of the funds to us until they've identified that investment. Like I said, some individuals, though, you want to get the account opened, see how long that process takes with $1,000, and just have that sitting there for a deposit or to get your place in line for an investment. It's there to get that process started, and then move over the bulk of the funds when you're ready to go. I had one client once where it worked out well. He had about $350 or $400 sitting with us. This was back in 2007. Brought cash to us, didn't do a single thing with it. The stock market tanked in 2008 and 2009, and he came and saw me in 2010 and said, "You probably think I'm an idiot because I've been sitting here with 350 grand in cash for 2 or 3 years. But the reality is I didn't suffer that big downfall in 2008, but that's about the only time that's going to make sense to do it.
Yeah. So I guess most people, they'd probably want to have another IRA at some other institution like Ameritrade or something, where it's not with an advisor, and just have it in like a money market there or something else liquid that's really low risk to at least get, at least just wash out inflation. And then when they find something, do a transfer and be ready to go.
Yeah. I think that's great advice. Yeah. Because then you're going to have it, and you're going to have it once you get it out of like a 401k or 403b plan into an IRA, even if that's, like you said, in a money market at a brokerage firm. It is easier and quicker generally to transfer money from an IRA than it is to get that rollover from a 401k. So at least you got that money primed and ready, but it's sitting in it and you're earning a little bit of interest until you're ready to pull the trigger.
So if I have funds that I'm using to invest, do you have traditional products to where I can move them back and forth depending on whether, if I sell an asset or buy an asset, so that it's earning money while I'm identifying my next asset?
We're not a broker dealer, so we don't. So it is it does just sit in cash with us. No interest is paid. There's no other investments that we can place it into. So again, it's kind of just the alternative assets are what we handle.
Gotcha.
And earlier you mentioned the things that you can't invest in, and one of them that you mentioned was collectibles. I'm really curious what qualifies as a collectible versus, because like, we chatted this weekend about some really weird things that you can invest in, right? Mm-hmm. Like, so what makes a collectible? Because I know you could theoretically invest in a horse, right? Like a racehorse. Could you invest in a car?
You could, in theory, you could invest in a car. I think you would have a couple things about investing in a car. This is a great question. I've had this come up over the years. So if it was a collectible car, like a 57 Chevy or something like that, probably not, because it's rare. But if you were to invest in an automobile that, you had it stored at another facility, so you weren't ever actually driving it because you'd be prohibited from driving it, you could have a car in the IRA that is simply leased out on weekends, or you run it through some other company where they're leasing that car, and you're receiving those whether it's a lease or whether it's just a weekend rentals, that income coming back to your IRA. So you can, the car by itself is not prohibited. It would be the fact that it's, a rare car or something like that. If you were just simply holding the car and putting it in a location where you're just keeping it and hope the value goes up, that's probably more like a collectible than if you were taking the car and actually allowing people to rent it and generate some income off it. So the collectible question is a hard one though, because there are collectible coins, rare coins out there that would be prohibited, but gold and silver American Eagles are not prohibited. There's an exception for those. You can hold those in an IRA because the value of the coin is the value of what gold or silver is trading at. So there's, again, not a full list of what collectibles are. It just says life insurance and collectibles. So kind of,
I would have to say that it'd be hard to own a car and not be able to drive it.
Correct. And that's why I think we don't see many people doing it, because it'd be hard to own a nice Corvette or something that just to lease out on the weekend that you never go test drive.
Yeah.
So.
Well, that's kind of interesting because there is that platform. I think it's like Turo, where you can rent out like nicer high-end cars to people that want to just rent it for the weekend. But I suppose you couldn't just like rent it, say, to your brother, or I guess you could do it to your brother, but not to your dad, because it has to be like direct lineal descendant.
Correct. Although if you were renting it to your brother so he could come pick you up, technically
so
that's
just
prohibited.
Can't touch the damn thing.
But if you just wanted to, take off on his Uber career, then you could invest in the car. He could drive that, just pay back to you.
Sure.
Oh, yeah.
But we all know that a car's a horrible investment, so it's to do this.
Yeah, I'm just trying to push the balance here to understand, like, because collectibles seems like a really gray area.
Yeah, it is. I think the one that that people probably need to watch out for is like the trying to do like a vacation rental, or like trying to do like an Airbnb thing where they're gonna try to use it once or twice a year or something like that's off, right? Can't do that.
It is because of the personal involvement. Now, the thing we certainly have had clients who do Airbnbs and VRBO or properties, as long as it's strictly for investment. The only thing I caution people on those types of rentals, any rentals that are less than 30 days, a lot of times in a lot of states are subject to sales tax. And so while an IRA is exempt from income tax at the federal level, it is not exempt from local state, sales and bed taxes, things like that. So that's just something to consider. Obviously, I think a lot of those Airbnb places probably you factor in the bed tax into what the cost of each night is. So.
And you also can't really participate in the operations, right? So you can't be the property manager. Is that correct? You can't do maintenance work on it. Like, it's got to be completely hands off if you're going to try to go down that road, right?
Pretty much. I mean, I would say definitely can't be doing the work on the property. That's kind of what we teach when we do our classes. Your sweat equity of, painting the walls, mowing the grass, things like that are prohibited. I think if, let's say you were to buy a rehab project. If you were to go out there and say, okay, here's what I'm going to do to the property. I need to put on a new roof. I need to paint. I need to put in new carpeting. Make those decisions, hire the proper contractors, and then have your IRA pay them. I think that's fine. I think if you're renting the property out and you're finding your tenant and then directing your tenant to pay the rent back to your IRA, and that's really all you do, I think that's okay. It's more, we kind of like it when you're really getting your hands dirty and doing something like that. That where the issue's at. And I certainly have gone down rabbit holes with people on what's property management and what's not, but that's kind of where we fall out.
And I don't think we mentioned this yet, but like, what happens if you do a prohibited transaction?
So if you engage in a prohibited transaction, and I'll preface this by saying a lot of times people ask, how is the IRS ever going to know with your Airbnb property that you were there on the weekend, right? And the answer is that they're probably never going to know. But the reality is the way they try to curb that behavior is the penalties for a prohibited transaction are severe. So if you engage in a prohibited transaction with your IRA account, your IRA ceases to be an IRA the year that activity took place. So the IRS is basically saying, once you decided to go live in that property on the weekend or go vacation there, that day the IRA was distributed to you. So you should have had if you were in a traditional IRA account, your account should have been fully taxed to you. And if you were under the age of 59 and a half, you have a penalty. And where that penalty gets severe is that I'm guessing people don't get caught right away. If you were to get caught, living in the property, and the IRS says, this looks like this activity has been taking place for the last 4 or 5 years, they're going to say you should have distributed that property 5 years ago, and you didn't. Yeah. And so now you have they'll go back, and you have penalties and fines for not reporting that tax hit years ago. And so they can seize 100% of your IRA account involved in a prohibited transaction.
It's not worth the risk.
Correct. And that's, like I said, they swing a big hammer to discourage that type of activity. Now, how often do people get caught? Probably not very often. I've heard some anecdotal stories here and there. I haven't ever seen it personally, but I've heard of situations where people got caught.
Yeah.
And I think one was a angry neighbor. You upset your neighbor, and then they do a little digging and nosy neighbors. The one case I thought was interesting, I actually heard about this from someone I've known for a while. A father's IRA had lent his daughter money on a mortgage for her house. So it was a direct prohibited transaction for the father to lend money to the daughter. Now, when that transaction goes through the administrator, like it comes to Advanta, if we see similar last name or same last names, we're going to question, why, what is this relation to you? My guess is the daughter had been married and had a different last name. Mm-hmm. So the IRA administrator just sees a loan from Smith to loan to Jones, doesn't raise any flags. But the way it was relayed to me is the IRS caught the prohibited transaction because the daughter on her tax return was taking the mortgage interest deduction and told the IRS that she'd been paying interest to her dad's IRA account. And so in them looking at her tax return, caught it. Yeah, she admitted it, didn't, and it's probably a situation. She'd had no idea. You never know. The dad may have had no idea. I've had people call me sometimes. My CPA told me I could do this. I'm like, really? Because I don't think you can. Like it's so people get bad advice or they don't ask enough questions at times. That's what we're here for, is to answer those questions.
I can't remember on the prohibited list of people that you can transact with. It's linear, so I can't do a deal with my dad or if I have children. But if I have a stepmom, what does that skirt it?
So I'm trying to think stepmom. So stepmom for your IRA to lend money to her, probably. I'm trying to think. Your IRA lending to your stepmom, probably not an issue because it's not your parent. Although the risk in even dealing with stepmoms or children of different marriages, things like that, is whether or not the transaction is still benefiting somebody who's disqualified. So even though my IRA could lend money legally by the letter of the law to my stepmother, if she's using that money to then take my dad and her to go on a vacation or make improvements to their house, he's now benefiting from it too. So you got to be careful there. And I don't know how much the IRS would bother with something that fine line, but that's a concern. So a stepmother is not prohibited for your IRA, but if it was her IRA lending money to you, maybe a little bit different story, because now again she's benefiting the child of her spouse. So again, there's not been a lot of litigation in this area. That's the other problem with the prohibited transaction rules, is there's the letter of the law, and then obviously there's case law that fills in the question marks, and there just isn't a lot of case law in this area.
So that's up and down, and then sideways to your brother, sister, that's fine.
That's fine. Again, as long as you're dealing with them on an arm's length basis, absolutely. We definitely have had people lend money to brothers and sisters or rent property to them or invest in their syndication deals. Not a problem.
Do you know why that is? Why the linear thing works, or the lateral thing
but
works?
not vertical.
Yeah. Why is that?
I think my guess is they had to draw a line somewhere, right? So I think at some point they said if we're going to create disqualified persons, we have to figure out where that line is going to be drawn. And I think that naturally, Anthony, go ahead.
No, go ahead.
I was going to say, my guess is that for most IRA accounts, not 100%, but a lot of IRAs, a parent is the owner of the IRA, and their beneficiaries are their spouse and their children. So it's directly up and down their lineal tree. And I think they don't want the IRA to transact with somebody who's going to receive the benefits of that IRA eventually anyway. So since more often than not, the beneficiaries are spouses and children, I think that's what happens. Now, that brings up a good point. One way that a brother or sister could become disqualified is if they are your beneficiary. So if I had an IRA account and I named my sister as a beneficiary, I cannot now transact with my IRA with her because she's disqualified by being a beneficiary.
Okay, good to know.
That's a good little nuance.
So let's talk about risk. Right now, if I have my money sitting in a 401k or there's risk there based on what the market does. If I transfer it to you, I haven't invested in anything. You said it's insured. Now, once I invest it in something, the risk is assumed all by me, I presume.
It is. I mean, the risk there is going to be whatever you've invested into. Investing in an actual piece of real estate, for instance, you have property titled to the name of the IRA. The risk would be fire, damage, tenant destroying the property, things like that, where you would want to have property insurance for. If you're lending money from your IRA to somebody, you might want to get some collateral for that loan in the form of a mortgage, because your risk obviously is them not paying you, and you want to have some recourse against them to recoup some of your investment. And same thing with the syndication deals too. When you're investing, is what are my protections if this investment goes bad? What am I entitled to? Because there is no overarching entity that's going to insure those types of assets. That's when you look for real estate property insurance, or notes and mortgages, getting some security for the asset. So again, it's definitely the fact that there's a risk there, but certainly one you have to just consider those factors when you're going into the deal. And a lot of people, I think what you're alluding to, Rodney, a minute ago, just a lot of people think the stock market's risky. So investing in a house down the street in their neighborhood, or investing in their friend who's rehabbing an apartment complex, to them seems less risky. So it is that degree of what somebody's comfortable with doing, and that's again where Advanta doesn't get into trying to lay out those factors and help people make that decision. That is for the individual account owner to come to their own conclusion.
It's funny that you say that a lot of people think that the stock market's risky versus real estate. And I've run into people just the opposite. And I think it's part of it's unknown. You know, they're familiar with the stock market. They know that it ebbs and flows, and therefore it's a known risk for them, whereas real estate's not a known risk for them. But I think that goes back to, you know, vetting your sponsor and the operator of the deal that you're investing in, and understanding who you're dealing with and what their track record is.
Yeah, I mean, I think if someone had an IRA account and was a accredited investor, whatever, and was fully qualified to invest in any operator's deal, for them to just to do a Google search, find a name, call them up, and say I want to invest doesn't make much sense at all. It makes about as much sense as just throwing the proverbial dart at the stock board, right, and picking a stock without doing any research. But if you do your proper research, I mean, that's what's involved. I think that holds true regardless of what type of an investment is out there. Real estate or the stock market, know what you're getting into. But if you look at the numbers, you look at the deals, I think, you know, and again, it comes down to, you're right, it does come down to an individual. I think it's a fear of the unknown, or it's, you know, the enemy I know the stock market, I know the risk involved there, versus I'm not familiar with real estate. And at that point, you're probably having to educate some people on what the downsides are, what the upsides are, and let them make that analysis. But I think I've found, you know, over the years, at least the people obviously that are opening accounts with us don't fall into that boat. They're the ones that either have been investing in real estate their whole life with personal funds, and now they're just using their IRA for their next investment, or they've done enough research and done enough diligence on that type of investment to feel comfortable doing it. And I think the important thing to note as well that gets lost in the shuffle is it's not an all or nothing proposition when you're looking at self-direction. So if you presented with an opportunity to put 50 or 100 grand into a syndication deal, and you have $200,000 in your IRA account, you only have to move that 50 or 100,000 that you want to make that investment with. It's not move all your money over and you have to forget the stock market. It's carving out a portion that you feel comfortable doing with, and I guess, lack of a better term, kind of playing with, you know, a little bit. And doing that, making that alternative investment, see how it goes. That's something I've seen a lot of clients do over the years, where they tested the waters with an amount they felt comfortable that, you know what, if I put my money into this investment and it tanks or it does terrible, it's not going to ruin me. But if it takes off, it'd be a great investment. And they put that money, see how it went. Things went well. They got the returns they were promised, and then decide, okay, now I'm feeling more comfortable about putting a little bit more money into each deal. So that's something, again, that's important, I think, for people to remember, is that it doesn't have to be one or the other. You can have two different IRAs, one at a brokerage firm, one in a self-directed account, making different investments in each one.
Yeah, I think that's great. I think that's really great advice, because the proof will be in the pudding, right? Give it a couple of years with each, see which one's bigger at the end of it. And then, you know, it doesn't matter what everyone else is saying and what all the rhetoric is and what all the propaganda says. It's like, just look at the returns, go with the numbers. Which one's doing better?
Hey, Scott, I want to cycle back to something you mentioned before, which was that there's not a lot of litigation or case law in this area. But I know from our previous conversation that the self-directed IRA has been an option since like the 70s, right? So there's almost 50 years of track record there, theoretically, to have accrued some case law. Mm-hmm. Has it just not been very popular or prevalent in the past? Is it gaining traction now as kind of apartment syndications are becoming more popular, or what's the reason behind that?
Yeah, I mean, I think it stemmed from the fact, again, that most people are not familiar with it. So if less than the best estimates are about 5% or maybe a little less of retirement funds are self-directed. So in the trillions of dollars that are out there, it's a very small piece of the puzzle. Mm-hmm. So I think that's definitely part of it. The second is the IRS does not actively, at least not, I haven't seen it, actively audit IRA accounts. So if they start auditing an IRA and questioning an investment, then that's where the potential for more case law comes out of. The taxpayer challenges back to the IRS, and then it goes to the court system. So because they're not really auditing IRAs, you're not seeing that either. And I think one of the other factors is people, when you look to push that envelope of what's allowable and what's not. We talk about dealing with different people who may or may not be disqualified based on their relationship. Or if I want to invest in a company, my IRA is going to invest in a company that my father runs, but he's the only 20% owner and everybody else is not disqualified. Is that prohibited? Gets into a gray area. I think that the onus and the general, you have two kinds of people. Some people say, I'll just do the investment, we'll see what happens. And you have other people that say, the reason I might get caught is enough to deter me from doing it. And there's not a lot of people that fall in the middle of, I'm going to get a proper opinion from the IRS on whether or not this is allowable or not, which you can do. You can pay $10,000 and get a private letter ruling from the IRS that says your investment is okay. And if I'm considering investing 50 grand into a deal, I'm not going to spend 10 grand to make sure it's okay. Mm-hmm. So I think that's the reason why there's a lack of litigation is just there's not a lot of auditing, not a lot of inquiries by the IRS, and there's not a lot of people seeking out those definitive answers to those questions. It's again, someone like, I'm just going to make the investment, and if I get caught, I'll argue with them later, and then they end up not really ever getting challenged on it because the IRS isn't really looking at IRAs as a revenue source, at least at this time.
Mm-hmm.
Yeah, that's true. You never know when they're going to change, right?
Yep. Well, and I think
any day.
It could change any day, and I think that the issue for someone if someone is flaunting the rules and doing a lot of things that are prohibited, they're probably doing things in their personal tax situation as well that are dubious, and then that's going to open them up to an audit. And when you get opened up to an audit, they're going to start looking at a lot of different things. And if you're mixing your IRA funds and your personal money and doing some things like that, you run the risk then at that point, I think, of getting caught. I think that's, again, where the biggest risk comes. But, we always operate, we talk to people about as if the IRS is looking at the transaction. Mm-hmm. And like I said, well, we can't make a determination for them when it falls in that gray area. I'll try to give people things to think about and can refer them to a CPA, refer them to an attorney who may be able to shed some more light on that or give them a little bit more information.
Gotcha.
Very good. Well, we are hitting the top of the hour here. We didn't want to go over 8 o'clock. So we got a couple people still in the chat, Nick and Mike. And if you guys have questions, now's the time to throw it in the chat so we can pepper Scott with it. Otherwise, Scott, where's a good place for people to reach you if they want more information?
Well, they can go to our website. It's advantaira.com. So ADVANTA. IRA.com is a good place to start just to get information. But to reach me directly, give me a call. My direct line is area code 727-581-9853, and my direct extension is 1123. That'll ring me up directly. So you can go there. If you go to advantaira.com, you can look at the Meet the Staff, find my picture there. There's an email. There's a link right there to email me too. So that's usually the best way to get a hold of me is by phone. Just leave me a message. I'll usually get back to you very shortly thereafter. And again, if it's someone who's listening who has an IRA or has an account with one of our competitors or out there in the self-directed space and just has a question about something and you can't get a hold of them, give me a call. I'm happy to answer some of those questions for you too.
Very cool. And I don't think we mentioned it, but you're actually down in Florida, right, Scott?
I am, yep. Well, we have our home offices in the Tampa Bay area. We also have an office in Atlanta, but we do work with people all over the country.
Yeah. So I've got people up here, investors in our deals who have been going through you. And so it's entirely possible for you guys to work with anyone in the U.S., I'm guessing, right?
It is. We have multiple clients in California. I think we even have one client in Hawaii. And then throughout, obviously a lot of our clients are in the, Atlanta metro area, the Tampa Bay metro area, but like I said, Dan, we've worked with a number of clients and individuals of yours, referrals from Minnesota, and pockets throughout the country. So it doesn't matter where we're located. And one thing I was going to mention, we had a minute or two left, or a couple of minutes, was just, we deal with two individuals. We deal with the individual investor. So in this case, Dan and Anthony, people that are investing their IRAs into your deal, we're working with them to facilitate that process. But then we also work with folks like yourself, though, the investment providers and sponsors, to help provide you with some knowledge and literature as well to help you better reach those passive investors you're looking for. So, we're always happy to work with, obviously, the individual IRA owner, but then also the people who are looking to raise capital too. So.
Yeah, no, that's what was really pleasantly surprising for me when I was referred to you by another guy named Jason Urusi is, we don't get any kind of like kickbacks or incentive for talking about Advanta. Like there's no financial incentive for me the whole reason we're chatting with you right now is because this topic is really valuable to people. A lot of people don't know about this, but also you've been a really great resource because we've had this relationship where previously if I had investors who wanted to do the self-directed IRA thing, I would basically say, well, okay, here I did a Google search. Here's like the top 5, try to figure it out, see what happens.
Good luck,
But
Godspeed.
with us, I've got an actual guy, Scott. Here, you can talk to this guy. He knows who I am. He knows what we're doing. He'll get you up to speed real quick. And there's just this, really robust customer service process that you guys have that I haven't seen with any other self-directed IRA custodian out there yet. I've only, had communication with a couple, so I don't have a huge pool of data there. But the others I've worked with just didn't really have the customer service at all. But it's interesting, their price point was about the same or higher than you guys. So,
yeah, I definitely appreciate those words. That's what we focus on. Is really that customer service. And I always try to. I've said this many times when I try to put myself in your shoes. If you've done the hard work to talk to a friend, talk to a colleague, talk to somebody you just met, and sell them on placing their money into your investment. And you've got them on board now for an investment. You're telling them it's going to be easy because, I have a guy with their IRA, you can help you with the IRA side. The last thing you need is a company to make it seem difficult. Because I mentioned it's not a difficult process.
Yep.
But you don't need a company to make it seem difficult and have that person now have second thoughts. All right, I was going to invest with Dan, and he said it was really easy. But now that I'm getting into this, it seems very difficult. So now I'm questioning what Dan's told me about his investment altogether. So that's been my mindset with investors like that, is to try to put myself in your shoes. Hey, I'm just here to help facilitate it and get out of the way and keep everybody happy.
Yeah, no, that is the exact reason that I raised my hand at this conference I was at back in September and asked this panel of syndicators, like, okay, who's your self-directed IRA custodian that you guys like to use? Because my handful of experiences don't give me much confidence. And I do not feel like sending someone, luckily, that experience with my sister, she's my sister, right? So she knows it's not me, it's not my deal. It's, these other companies are making it difficult. But my fear was, what about that first transaction with a new investor? I don't want that to be their first experience. And that's where I was like, okay, there's got to be a better solution out there. So very glad that Jason hooked us up, because you've been a wealth of knowledge and helped a lot of people.
And as a testament to you, Scott, Jason came up and found Dan afterwards and was like, here's my guy. Like, he was like eager.
Yeah, he was really excited to share the info. So I can see why.
No, Jason's a good guy, and I've known him for a couple of years too, and certainly helped him out and some of his investors too. And and the thing, you guys are all somewhat competitors in this space to an extent, but you're probably not always competing over the same properties. But we don't share. If you send an investor to us, we're all, again, because we don't sell investments, we're not going to tell somebody, oh, Dan sent you over. Okay, well, Dan only, here's somebody else who does this instead. This might be more attractive to you. That's not what we do. We're simply say, oh, Dan sent you over. Okay, great.
Yeah.
I know what investment you're looking to make. Let's get started on the paperwork.
Yeah. No, everyone I've met in the multifamily space so far has been very selfless and helpful. I haven't seen much of that competitive stuff that I've seen in other industries, which has been.
There's too many deals to go around, and there's too many extra hands that need to be involved to be.
Yeah, well, I think everyone understands it's a team sport, right? Yeah, you get way more out of helping other people than you do than from trying to.
Dan and we had a conversation the other day with Drew Whitson, and he had a fantastic story, which was he lost a deal to a competitor. And instead of looking at that as like a negative, he then tried to figure out who the person was that he lost a deal to, sought him out, found him, and then was like, hey, let's partner on this. And they took it down together. So, today's enemy could be tomorrow's best friend and vice versa. So
yeah, we're all trying to do the same thing basically. So.
Yeah, I've definitely noticed that. I've definitely noticed in my times in the different multifamily things that I've been to, there's definitely more of a collaborative environment than I think sometimes, other industries. And again, it's personality, and maybe that's what draws people to the multifamily is it is a collaborative space. The people who are the in it for myself and everybody else be damned kind of attitude are not going to be welcome at those events. And they're not going to be around.
Exactly. Well, Dan, we really appreciate your time coming on tonight and all the information that you provided.
Yep. No, happy
Did you already
to be part of-
share? You already shared contact info, right? Did we
Yep,
get that?
and we're going to put that in the contact information in the video and everything. That's going to be on YouTube after this, so that if people want to get a hold of you, they can.
Good deal. Absolutely. No, it was a pleasure being on with you guys. Great conversation. I'm happy to come back anytime if you have somebody that have a little nuanced, we did a very general overview. If you want to get more nuance on a couple different topics, or just bring me in front of the roundtable. This is fun. I'd be happy to do it.
Absolutely.
Yeah,
Awesome,
thanks so
Scott.
much.
Really appreciate it. And hey, everybody in the chat, thanks for stopping out tonight, guys. Really appreciate you.
Alrighty.
Thanks, guys.
Thank you.